I'm Leslie Shields with the Shields Agency, and we do employee benefits and health insurance for both entrepreneurs, individuals, and small businesses. And so some of the things Jean is going to talk on today are going to be focused around our small business clients and some of the things that they should know about and be aware of in terms of compliance for having health benefits in place. We will also be sharing, if you reach out to us, we can share our link that we have for core documents, where you can actually order some of the things that Jean's going to be talking about, and he'll walk you through the website. And then we can also share the PowerPoint as well as some additional videos. So reach out if you're watching this at a later date, feel free to reach out to us and we can share the additional information. But I'll turn it over to Jean and let him introduce himself and kind of get going here.
Good. Thank you for inviting me, Leslie. I am Gene Ennis with Core Documents. I founded the company in 1997, 28 years ago, and since then we've accumulated 75,000 clients, plan document clients, and in that 75,000 clients, we've never had one client ever audited, questioned, investigated, or any benefits disallowed. And we feel like that is because we're a conservative company and we do a compliance check on every plan document before we produce it. And one of the differences in Core Documents versus all of the other competitors that we have out there, including payroll companies or PEOs or even insurance companies, is that Core Documents charges a one-time fee for plan documents versus an annual subscription. Almost all, and I think all of our competitors are charging an annual subscription, which means they're going to charge you every year. As an example, ADP and Paychex charges about $400 to $450 a year to provide Section 125 premium only plan services to their clients, whereas Core Documents can provide that same document and that same process for a one-time $149 fee. And Leslie with the Shields Agency is an affiliate of Core Documents. We currently have over 600 affiliates who have a website, an affiliate website with all of the same products. And so all of the products that we're going to go over today are on Leslie's affiliate website. So feel free to link to her site. All of the information that's on the Core Documents site is also on Leslie's site. So what we're talking about here today is available through her website. Another interesting or important fact to understand is that all of the benefit plans that we're going to talk about today have short videos. This is a 3.5-minute video on adding the HSA savings module to a Section 125 premium only plan. And what I want you to understand about these videos is that the content of these videos came about over many, many years of providing this information to clients over the phone who needed those last few questions answered before they could sign up for a plan document. So what we've done is we've taken all of that information that we would normally provide to a client on a telephone call, and we've put it into a 3-minute informative video. And the idea was to try to reduce the time that we spend on the telephone. But the good thing about these videos is they're available 24/7, anytime you want to go in and look at one. If you want to just go to Leslie's site and look around, there's a video on most of the products that we're going to talk about today on her site. And there are slightly different videos also available on the Core Documents website. So if you go to the Core Documents website, you're going to see the same products that we're going to be talking about here today. But I've put together a PowerPoint presentation that I would like to just run through quickly. And this is going to be a resource. I guess it's going to be available later for sharing.
And we'll put it on our website and link to it as well.
The topic today is tax-saving benefit plans that require Core Documents. So that you don't get confused, we're going to go through a lot of screens here, and it's going to look like we're talking about dozens of different products. But in actuality, there are only a dozen products here. And let me try to simplify the groups of products that we're going to talk about. Across the top are the Section 125 cafeteria plans. This is just a nifty way for an employee to avoid all payroll taxes on health insurance, supplemental insurance like dental, vision, accident, group term life. You have a premium only plan that allows employees to just elect all forms of health insurance and supplemental insurance on a tax-free basis. Most employers provide this to their employees. A lot of employers simply set up tax-free deductions and don't realize that the IRS and Department of Labor will require them to establish a formal plan document. And without this, in the event of an audit, your Section 125 deductions, all the way back to when they started, would be reversed. They would be added back as taxable income with interest and penalties. So it's important that you set up a Section 125 document before you start pre-taxing benefits to your employees. The next module under a Section 125 plan is the HSA. Employees can also avoid taxes on HSA savings, and they can enjoy an additional 7.65 or approximately 8% in FICA tax savings that they do not get if they wait until the end of the year and take the HSA deduction on their tax form. If they take the deduction under a Section 125 plan, the employee also reduces 8% in FICA taxes, and the employer saves an additional 8% in FICA taxes. It behooves an employer, and I'm going to show you some sample tax savings to the employer, but it behooves the employer to allow an employee who has an HSA savings account to do it at work, because it reduces the taxes an additional 8% for the employee and the employer. And then under the Section 125 cafeteria plan, you've got a health FSA, which is basically medical expenses, out-of-pocket dental, vision, medical, co-pays, deductibles. In 2025, the maximum is $3,300 a year. The dependent care assistant plan on the right here is simply $5,000 a year that the employee can elect pre-tax or tax-free for daycare expenses while the employee works. So that's the cafeteria plan. The reason they call this a cafeteria plan is because the employee can either take their money or money that the employer has allotted, and they can take that money and they can put it into the premium only plan. They can put it into HSA savings. They can put it into medical expenses or daycare expenses. The idea is the employee has choices under the Section 125 plan like they would at a cafeteria choosing food. And then on the second row here, you've got a WRAP SPD. This is a relatively new requirement. It was always best practice normally for larger companies, but the Affordable Care Act, effective January 1, 2014, made it mandatory for all employers who offer group health insurance, even employers with just one employee, to provide a WRAP SPD to the employee to provide the employee with all of the Affordable Care Act and Department of Labor and ERISA notifications that the Affordable Care Act wants the employees to know, to make sure that employers didn't simply disregard it like so many employers are today. They put teeth in this WRAP document requirement by implying a $110 a day fine for employers that don't have them. So if the Department of Labor requests your WRAP SPD document and you can't provide it, they will start a $110 a day fine. Then you've got the transit benefit we're going to talk about, which is a commuter. This is not used that much. This makes up less than 5% of our business, but for employees in a metropolitan area who have commuter transit, train, bus, subway expenses and parking expenses to work, this allows employees to put away up to $650 a month in tax-free transit and parking expenses. And then something that is new and going to expire this year is the Section 127 Educational Assistance Plan that allows employers to reimburse up to $5,250 a year for student loan repayment and educational assistance. So this is going to be more popular in your professional employers like dentist or medical or accounting or anywhere where continuing education is ongoing. But through the end of 2025, Employers can also reimburse $5,250 a year in student loan debt, which is new. And then we have administration. For those clients who prefer to outsource administration, and only about 10% do. Most employers administer their own plan. But for those clients that want to outsource it, it's about $10 a month. The employee gets a portal just like they would through their bank account. They get a debit card. So the money that's deducted from their check is automatically in an account, just like their checking account. They have a debit card. They can go to the doctor or the pharmacy or whatever and use the debit card. This way, they don't have to spend the money or have the money taken out of their check, spend it a second time, and then wait to get it back. But not all employers choose it, but it is an option that's available. And then across the bottom, we've got 5 different HRA plans. The difference in a Section 125 cafeteria plan and an HRA plan is that Section 125 is just a nifty way to avoid income tax on premium, medical expenses, daycare, and HSA savings. Your HRA plan is a miniature self-funded health plan. It's Section 105 and Section 106 of the Internal Revenue is the same part of the Internal Revenue Code that allows self-funded insurance. So all of your HRA plans are basically a small, limited, self-funded health plans. We have a HRA for just one employee. The significance of that is one employee does not constitute a group, and it avoids most of the Affordable Care Act mandates. All of these other HRAs, the HRA here, this is a standard old-fashioned HRA that can be designed 100 different ways. The employer could design this HRA to be comprehensive. It's integrated with a group health plan where it picks up every out-of-pocket medical expense that's not covered by the health plan. You can also set up a deductible gap HRA where the employer chooses a much higher deductible. The employee pays a lower deductible. The HRA picks up the difference. And the employer normally saves substantially by using a higher deductible and then cushioning that effect to the employee with the HRA. So the employee doesn't have to pay the $5,000 deductible. They pay their old $1,000 deductible or $2,000, whatever it was, but the employer realizes extra savings by using a $5,000 deductible and ensuring that the employee doesn't have to pay that excess. This way, the employer only pays that extra deductible for employees who have it, and actuarially, only about 15% of employees in a group are going to have a deductible expense during the year. These other 2 HRAs here, the QSEHRA, QSEHRA, and the ICHRA, these are 2 newer HRA plans. The QSEHRA was released in 2017. The ICHRA was released in 2020. Both of these are designed for employers who do not want to offer group health insurance, but they do want to offer their employees X amount of dollars so that they can go buy health insurance on the exchange or on the individual market where they would get to purchase exactly what they want. And then on the far right, you've got an accepted benefit HRA, which is basically just an HRA that you can design for dental or vision or copays or deductibles. It can also pick up short-term disability. So these are the 12 products that we're talking about today. And to eliminate the confusion, you've got Section 125 cafeteria, and then you've got these HRA self-funded plans across the bottom. All right, so your Section 125 cafeteria plan has 4 modules. We've talked about that: premium only, premium with the HSA savings module, a health flexible spending arrangement, and a dependent care assistance plan. We'll go into more details later, but this is just kind of an overview of each of the products. The Section 105 HRA, I told you a minute ago, one employee did not constitute a group health plan for the Affordable Care Act, so it avoided or it escaped most of the ACA mandates and limitations. This is important because a small employer or a micro business who wants to hire their spouse, the spouse is the employee, and the owner of the business becomes the dependent of the spouse on the HRA. And this is a kind of a backdoor way that's perfectly legal for an owner of a micro business, a small business, to hire their spouse, provide the benefits to their spouse, and indirectly cover themselves as well. Then you've got a group coverage HRA. And the reason we call this group coverage is that after the Affordable Care Act took effect in 2014, all HRA plans had to be integrated with group health insurance coverage. The reason for this was the Affordable Care Act mandated that all health insurance plans had to eliminate annual and lifetime maximum limits. Most health plans before 2014 had a $1 million or a $2 million annual lifetime limit. The Affordable Care Act eliminated that, and that's one of the reasons that healthcare is so much more expensive today, is it's a blank check with no limits. Prior to 2014, clients were able to set up an HRA plan and just give employees $100 a month or $200 a month to go buy whatever they want to, and if it wasn't enough, the employee could pay the difference. Because that HRA plan had an annual limit of $2,400 a year or whatever, it no longer was legal under new Affordable Care Act laws. After 2014, all of your standalone HRA plans that could pay individual premium or pay employees to go buy their own individual premium were outlawed. So this created the group coverage HRA, or an HRA that's integrated with a group health plan. Employers use these in a number of different ways that we're going to go into later. The next benefit that came about in 2014, millions of employees across the country lost HRA benefits that allowed them to go buy individual coverage on the exchange or on the individual market themselves. This was a disaster, and after the IRS and Department of Labor realized what a disaster it was, they designed the Qualified Small Employer HRA, or the QSEHRA, and they introduced this in 2017. This is really designed for groups with less than 50 employees, and all employees who receive benefits under a QSEHRA have to purchase ACA Minimum Essential Coverage Health Insurance, or MEC. This means that the health insurance meets the Affordable Care Act criteria of no annual or lifetime maximums, a guarantee issue regardless of your health conditions, et cetera. And in 2025, the limits are set at $6,350 for an individual and $12,800 for family. Now, an employer could establish this for much less. They could give an employee $100 a month or $200. So these are just the upper limits and not what an employee or employer has to offer. In 2020, the IRS and Department of Labor came out with the individual coverage HRA, and this was designed for groups with 50 or more employees, or what's called an applicable large employer, ALE. An applicable large employer is mandated to provide affordable coverage to their employees. And using the individual coverage HRA, an applicable large employer, ALE, can provide an individual coverage HRA versus a group health plan, but they have to make sure that it's affordable. And affordable means that after the individual coverage HRA benefit has been applied, the portion that the employee has to pay himself or themselves does not exceed 9.02% of their monthly income. And so the difference in the QSEHRA and the ICHRA is that the QSEHRA can allow employees to continue to receive large subsidy discounted premiums via the IRS Advanced Premium Tax Credit, APTC. But under the individual coverage HRA, the employee is not eligible for any IRS Advanced Premium Tax Credit, which is the subsidy or discount.
Gene, are they on that one, the QSE? Right? Are they eligible for subsidy?
Yes, they are. However, the QSEHRA will reduce the subsidy dollar for dollar. So there are going to be situations where an employer has a low-paid employee where the majority of their premium is being picked up in a tax credit. And when the employer offers the QSEHRA, it will reduce that IRS tax credit, which means that the employer is simply going to bump the IRS out of the way and provide those benefits themselves. So that's a situation that employers need to understand. And with the QSEHRA, the employee cannot elect to not participate to keep from interrupting or disrupting their tax credit. It's mandatory participation, and the benefit is going to be added to their W-2 at the end of the year, whether they use it or not. So an employee who has an advanced premium tax credit will get a notice with their plan document. And that notice, they're instructed to take to the exchange, show them what the benefit is, and have their IRS advanced premium tax credit reduced so that it works in concert with the qualified small employer HRA. Now, if the employee does not do that, then the QSEHRA benefits could be taxable. The IRS could assess them a tax. It could also
we haven't seen a lot of groups elect the QSEHRA.
I think that's probably because it comes with so many rules and eligibility criteria that a lot of people just really don't want to wade into that. And one of the benefits, I think, of doing business with you and us is that we can make this simple. The agent or the client can simply come to us and say, here's what we want to do. Here are the issues. What do we need to know? And how would we go forward? And once the client has access to that kind of help, you're going to find that more people are willing to do it. To keep moving on here, the individual coverage, HRA, again, this is designed for the 50-plus market because there's an employer mandate to provide coverage to 50-plus employee groups. This particular HRA eliminates all tax credits through the exchange for premiums. So some clients simply want to use an ICHRA when they really need to be using a QSEHRA. And here again, this is where our compliance review and consultation is going to come in to help the client. The next plan document is the ERISA WRAP SPD. It was a new requirement or new law on January 1, 2014, and it requires all employers who offer group health insurance to provide every participant with a WRAP SPD, and failure to provide is $110 per day ACA fine. The WRAP SPD is simply designed to communicate employee and dependent plan rights and obligations and other required employer notifications. And the Affordable Care Act made health coverage so difficult to understand that this is the reason that they mandated the WRAP SPD and the rights and obligations that need to be communicated to the employee. This is something that's not provided by the insurance carrier.
And I think a lot of people think it is provided by their insurance carrier. So this is important to communicate.
Right. In fact, that's why this is called a WRAP SPD document, is that this is information that's not provided by the carrier, has to be provided by the employer, and the WRAP is designed to wrap around all of the other insurance carrier documents. So
Jean, if I just have, we have a lot of husband and wife only groups. If they have just themselves and their spouse on an employer chassis, do they need a WRAP document?
If they provide group health insurance, they do.
Even if it's just them and their spouse on it?
Yes, yes. Even if it's just one employee.
Got it.
All right, the Section 132 transit and parking. Core Documents was one of the first companies in the country to offer a plan document for the transit and parking. In 2025, it's $325 a month for transportation cost, which is going to be bus, train, subway, et cetera, and $325 a month for eligible parking expenses. So that's $650 a month that can be pre-taxed. That helps an employee with those additional expenses. But again, this is going to be more for your metropolitan areas and not so much used, but it's also available. And then outsourcing claims administration. The employee gets a debit card to access the funds. They get a web-based portal similar to their bank account. And the benefit to the employer is not having to handle or be liable for the employee HIPAA protected health information. Remember, if the client is only reimbursing premium under an HRA, there's really no HIPAA protected health information to worry about. Most employers who are just reimbursing premium only do it themselves. They just add that back to one check at the end of the month, or and a smaller percentage may just give the employee a check, but more likely the employer is simply adding it back to one check at the end of the month. Let me add this too. Every payroll software in the country, including all of your software provider or payroll providers like ADP and Paychex. They all have an HRA column that you can click and add, so that when you're calling in your hours or entering your hours into the payroll program, you'll have a new column that says HRA, and whatever that employee's premium is or whatever the reimbursement is for that month, you simply add it to that paycheck. And your payroll software is going to keep all of that separate. And it's also going to keep it separate as far as W-2 reporting at the end of the year. So really, with payroll software and or a debit card, a small company with just one employee could set up their HRA reimbursements through their payroll company and keep all of their expenses on one debit card. And it's just like having someone else administer it for you. So these plans are very easy to administer. All right, to get into a little more detail, the tax savings, and this is what I want to try to impress on anyone who looks at this later, is the tax savings. Most people are not aware of how much tax savings is involved. But employees with the FICA tax savings, which is Social Security and Medicare of 7.65, anywhere from 10% to 37% in federal income tax, state income tax, state unemployment, and workers' compensation, the employee can save up to 40%, but the employer can save 10% on every dollar that has been redirected through a Section 125 cafeteria plan. That's substantial. And I'm going to show you just what the savings are on one employee, so that employers who look at this later will be able to determine that this is not something that is going to provide, a lot of extra work and no extra income. These things are going to, the Section 125 cafeteria plan will actually pay dividends. All right, the plan basics for a Section 125 cafeteria plan: all participants have to be employees. Technically, owners have been excluded from Section 125 cafeteria plans since 2007. Participants may choose between at least two benefits, including cash and qualified benefits, such as a group health plan or supplemental insurance. And a lot of employers read that and they don't understand that, or they believe that if they offer this plan, they're going to have to offer the benefit, the qualified tax-free benefit. And if the employee doesn't want the benefit, they're going to have to give them cash. That's not the case. This is not the employer's cash. Technically, whose cash is it? The choice between cash and a qualified benefit is the employee's salary or his paycheck cash. The employee can decide to keep his cash or his payroll or his paycheck and not participate in the Section 125 at all, or the employee can take some of his cash and apply it to qualified benefits such as health insurance or supplemental insurance. And technically what that employee is doing is he's agreeing to a voluntary salary reduction agreement. That means that the employee is voluntarily going to give the employer back X amount of dollars every month so that the employer can pay the insurance premium for the employee. And this way it becomes a business expense, a tax-deductible business expense for the employer. And this is why it's a problem for employees who elect an annual salary reduction to change it later. The employee can change it, but there are qualifying events that have to take place for an employee to do it. An employee cannot come in and just say, I've decided I don't want health insurance anymore and I can't afford it, so I need to stop this deduction. The IRS doesn't allow that, because technically this is not just a nifty way to deduct health insurance premium. It's actually a voluntary salary reduction. And so employees need to understand that. When it comes to the premium or daycare expenses, that's not hard to determine. It is a little harder to determine for your health FSA medical expenses, because you've got $3,300 that you can set aside or reduce your income and give it back to the employer. But if you don't have enough receipts to turn in to get that $3,300 back, you're going to lose the difference. There is a use it or lose it provision. And employees participating in a health FSA need to make sure that they don't overestimate what they think they're going to spend, or they need to be a little more conservative so that they don't lose any additional funds. Now, there is a way to carry over the funds at the end of the year. We'll get into that in just a minute. So there is a written plan document requirement. Employers cannot just simply start pre-taxing insurance, out-of-pocket medical and dental, or daycare expenses without a written plan document in place. In the event of an audit, all of that would be reversed with interest and penalties, and employers really don't want to go there because these documents are very inexpensive. They start at $149 and they go up to $379 maximum. But when you see the kind of tax savings that we're talking about, the cost to set the plan up and to be compliant is not that much. All right.
I mean, that's one of the reasons we've chosen to work with you guys, is because you do offer these documents at an affordable rate, whereas we have seen other people offer them and our small businesses are like, not paying that, move on, you know.
That's right. That's right. And a good example of that is ADP or Paychecks. They will charge $400, $450 a year every year. So the idea there is that the employer is saving so many tax dollars that they're just getting some of it back. It's a profit center. And actually, I designed this company around the idea of the way I would want to purchase a document going forward. I don't want to pay for it every year if I don't have to. And so the information that the IRS and Department of Labor require in the plan document is the plan sponsor information, employee eligibility rules, coverage offered, exclusions, providers, claim procedures, loss of benefits, review procedures, name of the plan trustees and fiduciaries, the type of plan, plan administration. All of this is required to avoid litigation and problems where employees complain about the way the plan is being administered. We've never had, out of 75,000 plan documents, we've never had an employee complain about the way the plan was being administered because our plans are so well documented. But this is some of the information that's required. But the first plan, the premium only plan, every employer who offers employer group or supplemental insurance needs a premium only plan. Employees pay their portion of the insurance premium using pre-tax dollars through an annual voluntary salary reduction. These voluntary salary reductions become a tax-deductible expense to the employer. Without the POP document, all the premiums are taxable wages. You can cover any allowed insurance premium under IRS Publication 502. In fact, you can remove all of the mystery of what's deductible and what's not deductible by simply doing a search for IRS Publication 502 at the IRS. This will show you everything you can deduct, but generally it's group health, vision, dental insurance, group term life, accident, cancer, and other dread diseases. And if you add the HSA module, you can also include HSA savings. Here's something I want to show you. It's a sample of just the premium only plan. If an employer has just the premium only plan and the employee's monthly premium is $200 a month and they've got $25 a month in a dental plan, $240 in annual savings to the employer in 10% by doing away with the FICA tax, workers' comp, and on the supplemental it's 30. So you get a total annual savings for just one employee, deducting health insurance and a dental plan at $270 a month is the employer savings for just one employee. So the cost of the document is $149 for the first year, but after the first year, there's no cost at all, and the employer is saving up to $270 a month for an employee.
Does that have to get updated every year?
No, it does not. The only
What if
reason
your plan changes? It doesn't have
well, the only reason to update a document is if there's a change in the law, the IRS, Department of Labor, Affordable Care Act law, or the employer has changes in the eligibility, changes in the name of the company, or they're going to add an affiliate company, or they're going to change the benefit that they're paying, or once every 5 years. The Department of Labor requires these documents to be updated once every 5 years. Actually, you can look at this $149 price as a 5-year premium. Really, you can divide that 5 ways, or about $30 a year is what it costs you to have a premium only plan, as opposed to using an ADP or a paycheck. Now, the next option would be the Cafeteria Plan module. once you buy the premium only plan, you can mix and match all of the other options, the HSA module, the medical health FSA, and the dependent daycare expenses. All of these are modules. $3,300 annually can be set up through the health FSA, but any employer can have any combination or any one of these documents. So I've seen employers who only need the dependent care and that's all they set up, or all they want is to pay extra money on their employees' HSA, so they just set up the core HSA. So an employee can set up any one, or they can mix and match. Health FSA, we've brought up $3,300 a year, same tax savings to the employee and the employer as the basic POP. There is a uniform coverage rule, and basically the uniform coverage is this, and employers need to understand this. Uniform coverage means that the health FSA means that the employer becomes the insurance company and the employee becomes the policyholder. And the employee could set this plan up on day one of January 1 and not even make the first deduction and end up in the emergency room the next day and have $3,300 worth of out-of-pocket medical expenses. And the employee could turn that claim in January 1, and the employer would be liable to reimburse the full $3,300 annual benefit. So that's the uniform coverage rule. Although that's possible, it's very rare. And the reason that it's very rare is that the plan document does not make it clear to the employee that this is the case. It takes a savvy employee to take advantage of the plan and receive all of those claimed benefits and then quit. I mean, that's possible, but it is very rare. And employees who cannot come up with enough receipts have to forfeit the amount back to the employer.
All of this, I mean, I'm sure it makes my head explode. I'm sure our small business employers feel the same, but you guys offer a consulting service so they can call in.
That's right. I'm available to any employer, any of your clients who need assistance, they have questions, and that's all I do all day long. We provide compliance and plan design services to any employer. So this is just an overview, and employers are going to have other questions, and we'll be glad to help. But to keep moving here, there is a rollover or a carryover year-end balance option. 2025, if the employer chooses this option, the employer doesn't have to choose it, but if they do choose it, an employee can roll over $660 of their unused amount to the next year and continue to spend it then. Or they can elect a 75-day grace period at the end of the year where the employee has another 75 days to spend it, or use it or lose it. The excess returns to the employer to cover the administrative cost, and the health FSA can be customized to work with an HSA and an HRA. And again, we get involved there to help the client understand that too. But here's an example of a employee who's putting $220 a month away in a health FSA, $200 into their group health plan, $25 into a dental plan. The total savings in taxes, now this is to the employer. The employee is going to be anywhere from 2 to 3 or 4 times this, but the total annual tax savings to the employer for just one employee who is putting money in the health FSA and the group health plan is $530 a year. Now remember, the one-time cost is $149 or about $30 a year, because you're going to need to update that document every 5 years. So there's substantial tax savings to the client employer. And if it makes their head explode, they just need to ask the questions until they feel better, because there's enough tax savings here to make it worth doing it. The next module for the cafeteria plan is the dependent care assistance. This is not rocket science. Employees rarely, there's no uniform coverage here, so the employee cannot lose this. They can carry over their amount from year to year, but the annual maximum is $5,000 per year. And the only caveat is that the daycare expense has to be for the employee or the spouse to work or look for work. But this is a separate module. Another thing to understand too is when you add these modules to the premium only plan, instead of $149, they're discounted to just $100. So when you're combining documents, whenever you add the second document, you get a $50 discount or a $49 discount. So you pay the $149 for your first module, which is normally the Section 125 premium only plan, and the HSA module is only $30. The health FSA would be $100 instead of the full $149, and the dependent care is $100 as well. So if you added everything together, you're only talking about $379 for a 5-year document that is going to save the employer thousands of dollars a year. Now, here's a sample of an employee who's putting the maximum $5,000 a year into the DCAP or the dependent care. $200 into a group health plan, $25 into a dental plan. The employer tax savings is $762 a year, just offering a POP and a dependent care, a tax-free election for the employees. And again, it's $149 cost, $30 a year. And these are the kind of tax savings that the employers can enjoy. All right, so the HSA, in 2025, it's $4,300 a year for individuals, $1,550 maximum for families with a $1,000 catch-up. And the benefit, again, for setting up the health savings account through the Section 125 plan is that the employer receives an extra 7.65% FICA tax savings, and the employee gets an extra 7.65 FICA tax savings that they would not get if they waited until the end of the year to deduct this from their income tax. So the employee owns the HSA account, which stays with them, or even if they leave the current employer. There's no use it or lose it provision in the HSA. Funds at the end of the year roll over in the employee-owned account until retirement. And at retirement, the employee can take those funds tax-free for any purpose. Now, these are the minimum family deductibles: $3,300, out-of-pocket maximum $16,600, individual $1,600, $8,300. But here's an example of an employee who is putting $570 a month into their HSA savings, $200 into a group health plan, $25 into a dental plan. There's $840 a year in tax savings to the employer alone. Now remember, the employee is saving 2, 3, or 4 times this, depending on their tax bracket. Even in a 20% tax bracket, they're saving $1,600 a year just with these deductions here alone. And the one-time cost for the premium only plan with the HSA module is $179. We're talking about less than $40 a year to have this plan set up. Now, for a client that wanted to put everything together, group health, supplemental benefits, health FSA, dependent care, and HSA, the employer could realize up to almost $1,600 a year in tax savings on just one employee who is participating with these amounts right here. And this is not unusual. And the cost for a full cafeteria plan document is only $379. And again, we're talking about $50 a year. So in summary, the written plan documents required, employees save up to 40%, employers save up to 10%, and the savings begin as soon as you set the plan up. Now, here's another thing. It's not unusual for a client to find out that they can't find their document, or they set their plan up under a PEO or a payroll company 5 years ago. They never got a copy of it. They don't know where it's at, but they realize that they need to get a document and have it on file in the event they're audited. In those situations, we can amend and restate an old document, which means that a client who started a document 5 years ago and had a January 1, 2020, we can amend and restate that document. And the order forms ask these questions. When did your plan start? Is it a new plan? Is it an old plan? If it's an old plan, what date did your old plan start? And when do you want to amend and restate it? And that means that the document preamble would read, the XYZ Section 125 Cafeteria Plan, originally effective January 1, 2020 is amended and restated herein January 1, 2025. So we can help clients who wake up one day and realize, you know, I've been taking these deductions for years and I had no idea I needed to set this document up. And what the IRS does in these situations is they expect the client to correct the deficiency as soon as possible. So if you started a plan under a payroll company or under a PEO or under an insurance agent who just didn't bother, then we can correct that and get you fixed going forward.
That's fantastic. Yeah, I know we have, clients out there who just didn't know about the things they were supposed to. And I'll tell you, Jean, this has been the easiest explanation all in one place of these documents that I've seen in 10 years of doing this.
And everybody's confused. And that's where we come in. We can make this easy to understand. We're coming up on the end of the hour here. Let me kind of speed up a little bit here. A lot of these we've talked about already, the health reimbursement arrangements, but technically there are the one employee or spouse HRA, the qualified small employer HRA, the individual coverage HRA, and the group coverage. These are going to make up 95% of the HRA plans that are going to be chosen by an employer. The one person HRA, the tax savings can be up to $5,000 a year. This particular type of HRA has been around for 70 years. We see many clients set these plans up with no annual limit, which means they can put $20, $30, $40, $50, $60,000 through this Section 105 HRA plan and save substantial tax dollars. But this was made available under Section 105 of the Internal Revenue Code, under these revenue rulings. These are on our site. They're also on the affiliate site if you want to go back and read these rulings. The qualified small employer in 2025, it's $6,350 maximum for employees, $12,800 for those with families. The employer does not have to use these numbers. They can be any amount up to this. The employer needs to keep in mind, one of the caveats is, do any of your employees receive an IRS advanced premium tax credit? If they do, qualified small employer is going to upset it. It's going to change it. The employer is going to have to report to QSE. They're going to have to go back to the exchange, get their IRS tax credit reduced. If they don't do that, they could end up in trouble at the end of the year. And the reason I say that is because the T2 will report to QSEHRA. And if the IRS sees that the employee is receiving an IRS advanced premium tax credit through the exchange, and they're receiving an unregistered or unreported qualified small employer HRA, then that employee could be open for an audit. So it's very important, and we try to make sure clients understand, it's very important for the employee to make sure they go back to the exchange, get this straightened out. And in some cases, the qualified small employer HRA benefit is simply going to take the place of the IRS tax credit. And that's something the employer needs to look at too. If he's going to do that for every one of his employees, he may want to leave all of his employees on the advanced premium tax credit and not do a QSEHRA. And in those cases, we're going to tell the client, you're better off to let Uncle Sam continue doing what they're doing. Because
that's what we've run into in the last few years. Now, I think after the American Rescue Act additional subsidies expire, this may look very different.
Exactly. All right. Employees do have to provide proof of minimum essential coverage, and we provide clients with a list of those documents. Basically, everything that's available on the exchange and the individual market today is going to be ACA qualified minimum essential coverage. Reimbursements can be taxable, like I said, to the employee. Failure to report to the ACA. There is a notice, and we provide the client with the notice that every employee is supposed to take to the exchange. And this is what the exchange needs to be able to coordinate the QSEHRA benefit and the advanced premium tax credit. So also an employee who has lied to the employer, signed an agreement saying that I do have coverage, but they don't have coverage, they could be taxable. That could be additional taxable income to the employee too, if it's ever found out. Now the employee simply has to, or the employer simply has to rely on an employee signing a statement, I do have coverage. And so there's a written notice the employee needs to deal with, W-2 requirements, I explained that, eligibility and other guidance. Anybody who wants to take a look at that can go to IRS Notice 2016-67, Part 3, Administrative Procedures and Miscellaneous, and you can read all of this in plain English. So it's not rocket science. Then you get the individual coverage HRA. This came about 3 years later in 2020, and it was really designed for applicable large employers with more than 50 employees to provide tax-free employee benefits so the employee can go to the ACA exchange and buy individual health insurance. Now, although it's really designed for applicable large employers with 50 employees, any size group can participate. In fact, on a regular basis, we have clients come in, they've heard about the ICH, they don't know about all the other HRAs, and they go ahead and buy the ICHRA, and we go back to them and say, listen, if you've hired your spouse, you really should be in the Section 105 HRA for one employee and not the ICHRA. The reason is because this was designed for 50 employee plus groups, it comes with 500 pages of rules and eligibility. The old Section 105 HRA plan doesn't have any of that. And we recommend that employers, if we see that a client has chosen the wrong plan, we will go back to them and make sure that they get in the right plan. So even if you buy the wrong document, in our compliance review, we're going to come back and say, this is not the best document. We think you should be in this one, and here's why. All right, the employees also must report the ICHRA funds available to them. The reason for this is so that the exchange can determine whether the ICHRA benefit is affordable. And if the benefit is not affordable, then the employee can decline the ICHRA coverage, and they can take an ACA tax credit instead. An unaffordable ICHRA benefit simply means that the premium that the employee is left having to pay after the ICHRA benefit amount is applied is more than 9.02% of the employee's income. So if after the ICHRA benefit is applied, the employee has to pay more than 9% of his income, that means for the remainder of the premium, that means the plan is unaffordable. And if the plan is unaffordable, he can decline coverage in the ICHRA and accept the tax credit subsidized premium instead. Now, that's a problem for an applicable large employer. And the applicable large employer can get fined $2,000 for every employee who does that. And so we have an extra compliance review for applicable large employers who are purchasing an individual coverage HRA to make sure that the insurance agent made sure that the benefit amount that was being offered is enough to make sure the ICHRA is affordable. If it's not affordable, the employer is still open to the ACA applicable large employer fines.
We've seen that done on some of the carriers that are administrating the ICHRAs in some pretty creative ways.
Well, in fact, we've seen employers who have set up an individual coverage HRA for just $50 a month just to get the open enrollment, the exchange open enrollment, so that the group can go in and buy coverage. That way, the employee, regardless of what time of the year it is, gets to go to the exchange and buy the coverage, and the benefit in the ICHRA is so low that the employee declines it. Of course, it's unaffordable, and they get the tax credit instead. So some agents have done this. This is a little unscrupulous, I think, and it's something the IRS didn't think about in their 500 pages of rules and regulations.
They didn't think about that one.
We'll figure it out, but there are ways to scam the system here a little bit. But the IC or ICHRA, let's just call it an ICHRA, and it can also reimburse employees for out-of-pocket medical expenses. And this is a little more rare. Not all companies do this, but some companies do set up a comprehensive ICHRA so that the premium and out-of-pocket medical expenses qualify. So the one thing to remember too is the ICHRA cannot be integrated with a spouse's group health plan. A lot of people in groups without coverage end up on their spouse's group health plan, and that cannot be reimbursed through an individual coverage HRA, ICHRA. It can be reimbursed through a QSEHRA, and there are going to be cases where the ICHRA is not the best option and the QSEHRA is the better option. But again, your clients don't have to figure all this out themselves. They just have to give us the details on their particular group and what they would like to do, and then we'll tell them the most compliant way to do it. All right, for the group coverage HRA, This particular HRA is kind of a holdover of the Affordable Care Act mandates. It has to be integrated with group health insurance, but there are unlimited design options. And here, let me explain a couple of them. An employer, let's say you go to an employer and you say, listen, if you add $1,000 hospital copay, we can drop your premium $4,000 a year. And the employer says, well, that's interesting. How many of my employees are going to have a $1,000 hospital copay? Actuarially, about 10 to 15% might have that expense, or there may not be anyone who has a hospital copayment expense. But the employer can save $4,000 a year in premium by adding a $1,000 copay, and he takes some of that $4,000 savings in premium and he establishes a group coverage HRA, and he says, all right, we've added a $1,000 copay, and in the event any of you have to go to the hospital, this HRA is going to pick that up for you, so you don't have to pay it. Also, an employer could decide, you know what, if I go with a $10 deductible, I can save substantial premium, $20,000 a year. And I know that none of my employees are young. None of them are going to the hospital. I've never even heard of one of my employees going to the hospital. So I'm going to set up a $10,000 deductible. I know that only 10 to 15% could possibly go to the hospital in any given year. I'm going to save $20,000. I'm going to set up an HRA, and I'm going to pay $2,001 to $10,000. The employee is going to have their old $2,000 deductible. I'm going to pick up $2,001 to $10,000 only for those employees who have that expense. And if nobody has the expense, the employer saves the $20,000. If one or two employees do have it, he's saved enough premium to cover it anyway. You can also set these plans up for limited, where it's only going to pay dental, vision, a retiree benefit, or a Medicare benefit, or a copay, or co-insurance, or deductibles. So the plan design options are endless, but this is just another option where an employer could save some premium, buy a reduced policy, but create an HRA to make it more comprehensive themselves. And again, this is just adding a self-funded health plan to your other fully insured health plan.
And Jean, you could help us with the plan design on that?
Oh, yeah, that's what I do all day long. I will help 10 to 15 clients a day with compliance issues. And when an order comes in where a client did not consult with us, we will do a compliance review and we'll get back with them if we feel like they should make changes or there are issues. But the plan designs for a GC HRA or a group coverage HRA, you've got comprehensive, which means that you're going to pay all out-of-pocket expenses the health insurance plan doesn't pick up. You're going to see this in groups of doctors or attorneys or professional groups where they just want the best and they want as many write-offs as they can get.
Mm-hmm.
Have a limited HRA, again, dental, vision, insurance premium, retirement benefits. There are 1,000 options. Deductible gap, we've talked about that. Pick up a higher deductible, take the premium savings, set up a deductible gap HRA. The employee pays the old $2,000. The HRA picks up from $2,001 to $5,000, and the employer saves substantial premium. Medicare HRA. This is a little tricky, and we have to get involved in compliance checks here.
Do you do these, Jean? We've been talking to our clients about this because this is a big deal when it comes down to Part D plans not being credible anymore.
Right. The issue with Medicare is that Medicare in groups with 20 employees or more have to be the secondary payer. The employer or the health plan, the group health plan has to be the primary payer, and the Medicare wants to be secondary. And Medicare has large fines for employers who offer an employee an incentive in groups of 20 or more employees to go off of the group plan onto Medicare as primary. So for groups with 20 employees or less, they can have given one of their employees the option to drop group health coverage and go to Medicare without any liability. After 20 employees, it's riskier, and some employers do it. And Medicare really doesn't define what they mean by offering an employee an incentive to drop group health coverage. And some employers have decided, okay, I'm going to offer a little bit less on the Medicare benefit than what I would pay on the group health plan, so that this doesn't look like an incentive. And some employers do it. We don't advise it, but some employers want to do it anyway. But that's something that we're going to get involved and help you with. A retiree HRA is just exactly what it is. Whatever the employer wants to pay a retired employee in benefits, just define the benefit and we'll take care of it. This could be a standalone plan, doesn't necessarily have to be integrated with a group health plan. It can be just to take care of the retired employees. And then we've got the ERISA wrap summary plan description. Failure to provide the ERISA wrap within 30 days can trigger a $110 a day fine. It can also trigger an audit by the Department of Labor. And it's the main ERISA, DOL, and ACA mandated document to communicate plan rights and obligations to the employee. And this information is not in the insurance company's master contract, certificate of coverage, or summary benefits. It's not a wrap document. It's entirely different. And then you've got the parking and transit commuter benefit in 2025. It's $325 for parking, $325 for transit. Believe it, it's $20 a month for bicycles. But the uniform coverage does not apply here. The employee cannot lose the money, and the employer is not liable for more than the employee has in their account. All right, we're getting close to the end. I've run a little over here, but as far as questions that every employer is going to have is, do I have to have a separate fund or trust account to keep the employee money? And the answer is no. The sole exception to that is the HSA account. But the employee is going to have their own custodial HSA account, and this is not something the employer has to worry about. The employer simply makes the deductions for the HSA savings, keeps them in the general operating account until the end of the month, when those funds are wired or ACH'd or checked, mailed to the HSA custodian bank account. Otherwise, all the funds for the HRA and the cafeteria plans remain in the employer's general account, and the employer normally appoints one of the employees to keep records and keep the participant selections and account balances. Many companies choose to self-administer their own plans, but for companies that want to outsource, we do provide that. It's about $10 a month per employee. They get a bank-like online access portal. They get a debit card, and those funds are available to them whenever they need them 24/7. They also access to the account balance. So there's never anybody standing in the doorway in human resource trying to figure out how much money they have in their account. General plan design. An employer is going to need to choose a plan year. Most employers want to keep the calendar year, January 1 to December 31, or if they may want to line the plan up with their group health plan, April 1 to March 31. They need to choose a plan year. It doesn't need to be a calendar year, but if they want a calendar year, January 1 to December 31, but they start the plan in the middle of the year, they can actually elect a short plan year for the first year, like April 1 to December 31. And then the following years will be back on an annual calendar, January 1 to December 31. So employers don't have to wait till the first of the year to start these plans. They can start at any time of the year, elect a short plan year if you want a calendar year and it's not January 1. So that's pretty easy. Then the employer needs to determine what's the waiting period going to be. Standard waiting periods are 30 days, 60 days, 90 days. The Affordable Care Act limited waiting periods to 90 days. You used to be able to have a waiting period of up to 365 days, but the Affordable Care Act changed that to 90 days. And the 91st day is the latest that the Affordable Care Act allows on an ERISA plan. And the minimum number of hours the employee has to work per week to participate in the plan. Normally, this is 30 hours. That's the delineating mark for part-time to full-time is 30 hours according to the Affordable Care Act. And then the class of employees that may participate in a cafeteria plan, you may have different benefits for management, sales, early warehouse, sale, whatever. The employer is going to choose the health FSA rollover and contribution limits. The IRS allows $3,300, but the employer can limit that. The thing to remember is the uniform coverage rule. They can lose money if an employee takes all of that money in the early months of the plan year and then quits or gets fired. But this is rare. In fact, it's so rare, I can't even count on one hand the amount of times I've seen that happen in 28 years. So it's not something that an employer needs to spend a lot of time worrying about. And then year-end fund rollover, we've talked about that. 2.5 months, 75 days, or 660. It's a choice when you enroll. And if they don't choose these two options, whatever's left at the end of the year is surrendered under the use it or lose it. Elections. Employees are generally bound to the election for the full plan year. The employee makes all elections during the company's annual open enrollment. This is normally 30 days before the start of the plan year. The employee gets all of the information, make their elections, sign the forms, give it to payroll. Payroll sets it up, starts the deductions. But they're going to have an open enrollment period for group health insurance, supplemental benefits, and if they want to participate and make contributions to a health FSA, dependent care, or an HSA account. And employees are generally bound to these elections for the full plan year, unless there's a qualifying event. A qualifying event is going to be changes in the household, like a marriage, divorce, new child, death, changes in residence, moving to a new zip code. There are ways to make a change, but it's not something that's easy to do and that the employee needs to be able to count on being able to do. The document and the summary plan description will define exactly what the qualifying events are for the employee. Loss of insurance, other reasons. An employee may become eligible for an employer-sponsored plan under a spouse's plan, but owner participation, this is the end here. Technically, owners have been eliminated or excluded from cafeteria plans since 2007. However, for a sole proprietor, they can hire their spouse who can participate in the Section 125 plan, and the owner can be a dependent. So through the spouse, the actual owner, through a backdoor way, can get their benefits tax-free through their spouse. And consideration has to be taken regarding discrimination testing, but that's never really a big issue. For limited partnerships, which is basically a partnership or an LLC with two owners, it's just like the sole proprietor. They need a spouse who can be an employee, and then the owner can also end up being a dependent on the spouse's policy, and they get their benefits tax-free as well. For S corporations may not participate in a Section 125 plan, but they can participate in an HRA. So that's important. So if an owner was an owner for any period during a year, they're a 2% shareholder for the entire year. C corporations are a little bit different. The reason is because the C corporation is taxed double. The C corporation pays a tax on income, and then the owner pays another tax on their 1040 tax return. As a result, the C corporation gets a little more tax deductions than the S corporation. But for a shareholder of a C corporation, it's also an employee, they can participate in a Section 125 plan and an HRA plan as a business expense without any issues at all. Rules for owners in an LLC. So actually, the most common is going to be sole proprietor, or what they call a disregarded entity. Once you have a second partner, it's a partnership, and partnership rules apply. But if it's a disregarded entity, which is one owner, or a partnership, which is two owners, they need a spouse. C corporation, the rule for C corporations generally apply. Be sure to consult with a tax specialist, just so that there's no problems at the end of the year. That's basically the end of the presentation here. Again,
so what I'll say is a couple of things. One, we're going to take these videos and split them up kind of into topics. We'll post the whole thing on our website and share it with our clients, but then we'll post it up to topics too. But this is, like I said, been an incredible overview of all of this information. And then I think one of the most valuable pieces here is just giving them a call for a consultation, because there is so many moving pieces. I had one question. If you have had benefits in place for several years, but not had a wrap document, can you backdate that wrap document?
I can. There are no laws. There's nothing in the code that says you can't backdate a wrap SPD document. So as soon as you figure out you have the deficiency, we can actually use the original effective date back to the last health plan that you've got.
Okay, cool. That's great to know. And then the other thing I had was, do you guys assist with, just because somebody just asked me, 1095-A forms?
We don't assist with the forms themselves because we're actually not licensed to provide tax advice.
Okay.
But we will provide them with every link that will help them understand that this is not a difficult process,
Yeah.
and it'll take it in the instructions. We'll take it on a box by box basis on what needs to be filled in. There are companies out there that we can send them to as well that specialize in this, but it's a service that we don't provide because we're not licensed to provide tax.
Well, and I'll tell you too, this is, we've worked with a lot of different people on these forms. And for the most part, the reason that our small business clients do not explore, two reasons. One, it doesn't make a lot of sense. And the people they may have consulted with may not be explaining it properly. But two, it's unaffordable. And that's what we've been really impressed with you guys, is that your products are affordable to our small business clients.
Right. Right. And, you know, the idea there is I simply designed this company around how I would want to buy plan documents myself as a business owner. And there have been, I mean, we have thousands of accountants, payroll companies, CPAs, and attorneys who prefer to buy documents this way as well.
Yeah.
And it's one of the reasons that we've been around for 28 years and have 75,000 clients.
Well, we love this. And thank you so much, Gene. We will get you a copy of everything that we splice out and put together. And we appreciate your time today.
Very good. I was glad to do it. Thank you for inviting me.